Hi, everybody. Welcome to the Stand in the Door Exit Strategies for Your Business, which is part of our Savvy Business Owner series through BKA Benefits. The Savvy Business Owner series was created to help you as a business owner or someone responsible for benefits, exit strategy of your business, any of those things that affect what you do on a daily basis. We are trying to provide you as much information by bringing you experts in these areas and helping you to understand. So I wanted to start off by going back to when I was 21 years old. I began my life for my first career as an Army Ranger. I jumped out of airplanes for a living, spent many years overseas in different environments. Finished my career during the Gulf War, right after the Gulf War. And one of the things that was a tradition of my unit was the last day before you leave, we jumped out of an airplane once again. It was us jumping out of the unit at that point. So if you can see on this picture, you'll notice that my hands are absolutely with a complete death grip. And you'd think with over 250 jumps during my career that I would have enjoyed this process and I would have gotten better at it over time. But I will tell you, after 250 times, it was a miserable experience every time. I don't like heights. I don't like falling from the sky. It was one of those things that it was just my job and I had to do it, and that was it. So one of the things that I developed over the years was a mantra that I would say to myself before I was getting ready to jump. And that mantra was, gravity works, hope this parachute opens, don't land on anything sharp. And that's what I'm saying there as you see me on the screen. Gravity works, hope this parachute opens, please don't fall on anything sharp. Gravity works, hope the chute opens, don't fall on anything sharp. And gravity works, boom, out the door. And when you're jumping out of an airplane, it is like hitting a wall of wind, because this is in an airplane that's going along at about 140 to 150 miles an hour. And you're jumping out of it and getting hit by that slipstream immediately. So instantly, gravity does work. Instantly, within a few seconds, the parachute did open, which was wonderful. So I only had one worry at that time, and it was a little bit of time to float down, and that was don't land on anything sharp. Well, I landed, I finished. One of the things when you are a ranger is you have to be cool. You can't, I couldn't jump up and down and say, I'm alive, I'm alive, I'm alive. I had to be cool about it. Got rid of that jump, and I was done. And I never had an interest in ever doing that again. So why in the heck am I telling you a story about being an Army Ranger jumping out of an airplane? Well, it's because when I look at business owners, they tend to act just like they're jumping out of an airplane when they're doing exit planning, or lack of exit planning in a lot of cases. So today we're going to talk about what it takes to get out of that airplane, make sure that you don't land on something sharp and your parachute opens as an exit plan. So who am I? My name is Jeff Kikel. I am the president of BKA Wealth Consulting and BKA Benefits Consulting. We are a full-service wealth manager that focuses strictly on mostly working with business owners, helping them to establish benefits for their employees, help them with wealth management in their own personal situations. And we also do business valuation and business exit strategy planning. So that's what I do. What we're going to talk about today is, first off, why you need an exit plan. Then we're going to talk about the two paths that you'll see in a minute. We're going to talk about understanding value, why we need a team around us, what are the steps of an exit plan, and then we're going to go over a case study. And that case study will be an actual case study of one of our clients. Of course, we've sanitized it so that you don't know what their business or their names are, but this is an actual client that we've worked with. So before we get started, I wanted to talk about some numbers. So the first number is 28. 28 is the 28% of private businesses that have done any type of exit planning. And this could be even just thinking about it, not actually physically writing it down. So it's a pretty dismal number, only 28% of private businesses that have done any kind of exit planning. The number 30. 30% of family businesses survive to the second generation. So for those of you in the audience or those of you out there that are thinking about, well, I want my kids to take over the business, realize that only about 30% of those family businesses survive to the second generation. And if you do no exit planning, it's going to be probably one of those 70%, unless your kids are miraculous. The number 20. That's 20% of the second generation businesses that survive to the third generation. So remember, we started with 100% of businesses, only 30% of them are going to survive to the second generation, and now only 20% of that 30% are going to survive past the second generation into the third generation. The number 70. 70% of businesses that do actually sell typically sell to a third party. And this is a very important thing, because a lot of people, and many of you are probably thinking this, well, I'd love for my kids, I built this business so I could hand it off to my family and all that. Well, realize that really only about 70% of businesses actually do sell to a third party and not go to the family. And there's a couple reasons why. One, sometimes family doesn't have any money to be able to buy the business from you. And sometimes they just don't want it. It was your dream and not theirs. So that's something you want to really be thinking about early on, and not, wait and then dump it in your kid's lap. The number 75. That's 75% of those who sold a business said that the sale did not accomplish their goals. Well, this shouldn't be a surprising number when we look at only 28% of businesses have done any kind of exit strategy planning. So it's no surprise that 75% of them would not be happy once they get things done. Many times it's the biggest check anybody's ever written to you, and you think that's fantastic, let's go, let's sell the business. And then you find out later on, well, that may be not enough to actually, live my life the way I want to. And last but not least, the number 100. 100% of those of you who have a family-held private business will have a transition at some point. You are not going to live forever. So at some point in time, you are going to make a transition, whether that is to your family, whether that's to key employees, or whether that's to someone else who's going to buy the business from you. 100% of your businesses are going to transition at some time. So you need to start thinking about that. So all of these numbers were put together by the Exit Planning Institute. We do a lot of work with them, receive some training through them. They're hard and cold facts that we've seen time and time again. And I will tell you, from being a practitioner, I've seen these in practice many, many, many times. So let's start by talking about the fork in the road, the two paths that you can take. But before we do that, I want to figure out if you are an S or a B. Now, I didn't say SOB, I said S or B. Well, one of the best books that I've ever read that was kind of that lightning shot, to your forehead that says, wow, it just kind of popped out for me, is The Cash Flow Quadrant by Robert Kiyosaki. And in the cash flow quadrant, and Robert Kiyosaki, if you don't know who he is, he wrote Rich Dad, Poor Dad. And this is his second book, which really dug into why his rich dad was rich and why his poor dad was poor. And the main reason for that is the dividing line right down the center. So you have a quadrant, you have 4 quadrants here. Everything on the left-hand side of the quadrant is people who sell their experience and expertise or they sell their time for money. On the right-hand side are people who utilize their investments in business to actually generate an income that can go on beyond them or is not interdependent upon them. So let's start on the left-hand side. The top left-hand corner are employees. Those are people who have a job. They're people that get up every morning, they go to work where somebody tells them where to be, and then they get a paycheck every 1 week, 2 weeks, whatever they get paid, they get a job. They have a job, and that job pays them whatever someone else feels their time is worth at that point. So some of us get annoyed with that process and we say, you know what? I'm tired of people telling me what to do. I'm tired of somebody else deciding how much income I should make. And I am going to go out and do this on my own. So they become self-employed. In that case, you own a job. You don't have a job, you own a job. Why is that you're self-employed and you have, you own a job? Well, yes, you own a job because if you stopped working any given day, you don't make money. So if you are a single, sole proprietor of a business, you stop working for any given day, you don't make any money. So that's what makes you different from somebody that is a business owner. Now, sometimes you might be self-employed. You may think you own a business, but you are self-employed and you may have employees, but if you stopped working, nobody's there to really keep the business going. So let's move to the right-hand side of the quadrants, and that's where we first off become a business owner. Sometimes a self-employed person decides to leave what they were, build a business, and then they get to a point where they've hired a few people and they start to standardize some processes and build a system to their business. They've got people working for them that can run the business following the system that you've created. Well, in that case, you're now a business owner. You could take 30 days off or a month, 6 weeks off or half a year off even in some cases, and the business will continue to run because you have employees that are following the system that you created. And this is the type of business that can really be sold, because when you start to look at a self-employed business, if you are the proprietor of that business, you might be able to sell your client lists at best. You may be able to sell some equipment, but if you're not willing to sell yourself into slavery, that business is interdependent on you. It's not so as a B business owner. When you're a B business owner, you could sell the business. Somebody comes in, they look at it and they say, this is the business I want, or this is a good strategic fit for my business. And in that case, they'll buy the business from you. Now, that doesn't mean that they're going to pay a ton of money, and there's some things that are going to affect that value, but it is a business that can easily be sold. The last quadrant is investors. That's where my money is working for me. Now, sometimes as an employee, I might save some money and then shift that money over to the I quadrant. I want to be an investor at that point. Sometimes I might be an E that says, you know what, I want to buy a business. And typically, a lot of times, this is things like franchises, where they're actually, instead of going out and trying to create all the systems and everything else, all they have to do is buy a system, hire people to run it, and they move on. So there's lots of ways that you can move within these quadrants. Very few people go from being a B business owner backwards to being an employee or a self-employed person. They typically are going to stay on that right-hand side of the quadrant once they get there. And a lot of times business owners might also be investing and investing outside of their own businesses. So when we start to look at the fork in the road and we start to look at the two paths, for those of us, and just what we were talking about before, for those of us that have a self-employed business, we own a job, there's not much value there. There is, unless you have something that is unbelievably attractive to an acquirer, there's really not much value. This is a good example of this is CPAs, attorneys, even some types of doctors. A lot of times, even though they might have people working for them, their business is massively interdependent upon them. And unless they can bring somebody into that business and kind of train them up to take it over, and then they go out to play golf, that business really doesn't have a lot of value. And quite frankly, the multiples on those type of businesses are not as high as other type of businesses. Let's look at the other path. Now, the other path are businesses that you can sell. These are the B quadrant businesses where there is a system, there's people that are there to run it, and those people are going to continue to be there, hopefully, when that person buys the business. And that's going to be a big factor, is ensuring that you keep those employees that are there to run the business, you keep them on board. Well, having an exit plan is fantastic. It's wonderful. Everything is great, except if you have something happen in your life. Mike Tyson had a great quote: "You can have the best plan in the world until you get punched in the face." Well, it's what we call the 4 Ds in our business. And the 4 Ds are death. You can have the perfect exit plan. I'm going to retire in 10 years. I'm going to sell the business at that time. And if you die, well, that kind of blows up the plan. Same thing with disability. If you're disabled and you can't work in the business and you've not really gotten it prepared to be transitioned, this can cause major havoc on the business. So death and disability are things that we look at when we do succession planning. When we do an exit strategy plan, we take a look at what the long-term nice part of this is, that you get to the end, you execute on the exit plan. But if you don't make it that far, we want to make sure that we have adequate life insurance in place. And this is usually what's called key man insurance or key person insurance, and disability insurance for the owner. And that could be in the forms of insurance that pays you an income because you're disabled, so that the business doesn't have to pay that, and then they can bring somebody else in to help run the business. Or it could be what's called business continuation insurance, meaning that something happens to me, I'm really integrally part of the business, and now I have to have something to keep the business afloat while I'm disabled. That's where that business continuation insurance comes in, where it gives the business some assets to be able to keep it afloat while you're transitioning and making sure that you have a new person in place to run the company. Now, the other 2 of the 4 Ds are divorce and business divorce. And many times, I can say this from the fact of running a business with my spouse. It's tough. It's tough enough running a business. And then when you're married to your business partner, it can be challenging sometimes. And you have to kind of have you have to really have your boundaries when it comes to work and then coming home, because otherwise you spend 24 hours a day with your spouse, and it can be tough. And when things get tough in the business, it can be massively tough. So in the case of a personal divorce between spouses, maybe not necessarily working together, that can cause havoc, because one spouse is going to want to get out of the business. They're going to want to get some money out of there. And quite frankly, if you've had a very ugly divorce, you want to get that person out of the business, or you want to get them paid off for whatever their responsibility was, or their piece of the overall assets. You want to get them out of the business at that point so that you can focus on growing the business. In the case of a business divorce, that's business partners that, quite frankly, I've seen some of these be way worse than a divorce, a personal divorce. You now have 2 people that have to work together. The employees end up being in the middle of all of that. And when people are fighting, it's very difficult for the business to continue to run correctly. So business divorce is a big challenge. So these are all factors that not only are we looking at in the case of an exit strategy plan, but we're looking at all of these pieces to make sure that we don't get punched in the face and don't have a plan for it. So now let's talk a little bit about the steps of the process. What are the steps that we go through when we're trying to figure out what an exit strategy plan is? Well, the first piece of it, and really I consider the most important right away, is value. What is the business worth? We've got to start with something. So there's three methods to figuring out a value of a business. The first of which is what's called a comparable company analysis. This is basically where we would take, as a valuation company, when we're doing business values or appraisals for a client, we will take a database. We have access to a database of thousands and thousands of private business sales. We look at businesses that are comparable to yours, so businesses that are very similar to each other. We look at, what they sold for, what some of the details were of the sale, what the financials looked like, and everything else, and we come up with a kind of perfect business and then compare yours to that. As a result of that, we also can understand with your EBITDA where your EBITDA is, earnings before interest, taxes, depreciation, or interest before interest, depreciation, taxes, and appreciation. All of those businesses that are out there, we're going to look at where they sold versus their EBITDA, and that will help us come up with a number for you that, you might be, based on what other sales were, you might be able to sell your business for 1 times EBITDA or 2 times EBITDA or 5 or 10. It just depends on the industry of what that comes up with. The second method is called discounted cash flow, and that's really more looking into your individual business, looking at the cash flows throughout the years, and we typically will go back 4 or 5 years if you've got operating history back to there. We're also going to look at the future a little bit as well, of some of the future projections of where you see the business going, and then we kind of work backwards into a number that somebody would be willing to pay for what the business has done, as well as what the future projections of that business are. The final method that's most common is what's called liquidation value. And liquidation value is really important in businesses that might have a ton of inventory, warehouse businesses. It's also very common in businesses that have a lot of material and equipment and vehicles and things like that. So big construction companies a lot of times are valued based on liquidation value versus, let's say a client list or whatever, because they have actual assets, and sometimes those actual assets are worth more than what somebody would just pay for a client list or connections or whatever. Well, when we determine value, we don't just choose one of those methods. There's an art form to doing business valuation. So, it might be that we look at all 3 methods that we've looked at up to this point, and there are a few others that are not as common, and we will put weighting on different values of weighting on those. So we might weight 70% of the value of your company towards the comparative company value, 20% towards the discounted cash value, and maybe 10% for liquidation value, and come up with a number based on that. And that, like I said, is the art of doing business valuation, of being able to kind of tweak and adjust based on what's unique about your company in that whole piece. So the next step is we want to look at what's affecting that value. So one of the things that we found early on, we worked with several business brokers, getting to know them, understanding what their job was. And a business broker typically is someone who either sells or buys businesses. Most of the time they're selling businesses for people. So they're gonna come in, they're gonna assess some type of value on the business. They're the ones that are gonna go out and market it to hopefully more than just one buyer. And the whole purpose of that is to get you to the point of getting a business closed. So one of the times we were meeting with our business broker friends, I asked them, we knew that there was a lot of factors that affected business, but I asked them, could we make it simple? What's let's say 4 or 5 things that are common, that cause a business sale not to go through or not to go through it, what the business owners thought. And they, kind of right off the top of their head said, well, there's 5 things. And we term those the 5 pillars of value. So the first of which is sales. So if you're a business owner and your business is focused on one salesperson, let's say you've got one key salesperson in your business, you better make sure that person is locked down, because if you sell the business, that owner, the person who's buying it, is looking at, well, I have this one key salesperson. If there's nothing tying them there, that has a major effect on the value of your business. The same is true of a business that has one key customer. And I'll give you an example. I had a client in the Dallas-Fort Worth area who was a major supplier of basically textiles to Walmart. And Walmart at one time, early in the days, had about a quarter of their store was focused on cloth, and it was a cloth store. So people would come in and buy cloth. They would come in and buy sewing materials and things like that. And that was a major part of Walmart in the early days. Well, if you've been to a Walmart lately, the sewing section of a Walmart's really only about 2 aisles. So imagine going from a footprint of having about a quarter of a store to now 2 aisles. Well, what ended up happening is Walmart already cut massively into their margin, because they said, well, we're Walmart and we can pretty much name a price for you of what we're willing to pay you. Well, that's fine if you're selling a quarter of every store. But the problem is when you go down to 2 aisles, it just becomes unprofitable. And that client actually went out of business as a result of that. So that's an example of a situation where you've got to really understand your business. And if you've got one key client, you've got to really start transitioning and building the business around multiple clients. Financials are a big one. That's the canary in the coal mine. So that's usually the first place that a potential buyer is going to look. They're going to look at your financials. They're going to see if the numbers make sense. And if the numbers aren't making sense, that's where they're going to start to really want to sniff around more and more and more. And they're going to dig in there even deeper and figure out why that is not looking the way it's supposed to. Operations. I call this the people, process, product. Everything from your hiring practices to, do you even have an employee handbook? Do the employees even know the rules behind this? Do you have things like golden handcuffs to tie down that key salesperson or that key operations manager that you have? Even just processes and systems on how you run your business. Remember when we talked about the B quadrant, that was, something that is a system and has people working there. So that's going to be really resolved within this operations category. Then you have leadership and culture. What they're going to want to look at is, well, who's going to be there after you leave? Are you such an integral part of the culture and the leadership of the company, or have you spent some time kind of building up those key people within your company so that they're really ready to take over? Because a business or somebody that's buying a business, they're not buying it because they want to get in the middle of it and do all this work in the business. They want to buy a business that is running, that they're not going to get mired into, because a lot of times they're trying to buy multiple businesses. And last but not least is owner readiness. And owner readiness, I will tell you from experience, is the one area that will sink a sale faster than anything else. Owner readiness comes in 2 flavors. First of which is financial readiness. And that one's pretty easy. We typically, when we work with a client and we're doing an exit strategy plan for them, we will do a financial plan. And that, what we're looking at is, all right, well, we've done a business valuation. We know what the business value is today. Here's our financial plan and how you've prepared up to this point. If you were to sell the business today, would you be able to, and would you have enough money to live the life that you want to live in retirement or, beyond the business? So that's pretty easy. It's the numbers are the numbers. They either work or they don't. The other side of the coin, though, is psychological readiness. And this is the one that's really tough. It's the one where we have to be a little bit of a psychologist. And I never thought that my degree in psychology would come into play ever. But I spend a lot of my time really trying to figure out if somebody is ready to make that jump. And sometimes they are. Sometimes they're already checked out, and that could be a problem as well, because they just don't care anymore and they're just ready to get out of there. Well, those are instances where we've got to make sure we work on that leadership and cultural side of things to make sure that we have a team that once we help them make some changes to their business is going to be there to run this thing because the owner's kind of checked out. The other side of the coin is people who aren't ready to check out. They're dragging their nails on the walls going out, and it might be a spouse or family saying, hey, we want you, it's time for you to leave the business. Even if you don't want to, your family is doing that for, or is asking you to do that. And sometimes that can really blow up with a business owner. And it's just this psychological thing in the back of their head. So the next step in the process is, well, who's going to be your buyer? Is that going to be a family member or family members? Is it going to be key employees that you want to take over the business at some point? Is it a strategic buyer or is it a third-party buyer? So let's go through these real quick. First off, a family or key employee buyer. One of the challenges, and if you remember when we talked about the numbers at the beginning, 70% of businesses typically sell to a third party, either a strategic or a third-party buyer. Why? Well, most of the time, family and key employees don't have enough money to buy the business out from you. And you might reach a point where you say, well, okay, I'm going off into the sunset and I need some money to be able to do that. And if they can't pay for that, well, then that's not necessarily a good thing for you. Now, a lot of business owners will say, well, I'll just finance the sale. That'll be fine, and they can just pay me, as much as or pay me out, we figure out a price and then they'll pay me out over 20 years. It'll be like an annuity. It'll be wonderful. It's great. It's fine. Works well, as long as Sonny Boy or Daughter Dear or key employee number one doesn't mess the business up in the process. And I've seen this happen many times where somebody has sold a business, figured that they would just, hey, I'm going to have an annuity for the next 20 years, that they'll keep paying me. Well, then the business starts to falter. And that person who thought, hey, I'm retired and I don't have to come back to work, has to come back to work to try and get the business righted and back on shape or on course, because their investment is at risk. So in these cases, we try and develop a strategy early on, and the earlier the better, where we identify those key employees or those family members who you'd like to take it over, and we do some things to make sure we financially prepare them to be able to just straight up buy the business out from you. Strategic buyers typically are not going to pay top dollar. These are people these are businesses that you might have a niche that is unique that somebody wants to add to their business. You might have a company that is in a very strategic or specific region that, let's say you're a trucking company and you own a trucking company that's kind of based in Southeast Texas. So you dominate the market down there, and you have somebody that's coming in from Dallas or maybe somewhere out of state and really wants to establish a territory down in that Southeast Texas area. Well, they could either come in and compete with you and you're already kind of sidled into the market there, or they could just come in and buy you. And that's very common. People will be a strategic buyer and they'll come in. So they typically want to pay a little bit less in those cases, but these are cases a lot of times where they might come in and buy you out and then say, well, okay, we still want you on board. We want you to continue running the business, and they're actually going to pay you, so you become an employee effectively of the company at that point and stay on board while you're either transitioning the business or, the best example of this is Warren Buffett and Berkshire Hathaway. Warren Buffett likes to buy businesses. So he comes in, he finds somebody's business that's been run well. He really enjoys businesses that are kind of family businesses, or early on, and he comes in and he provides capital to these new businesses. But one of the requirements is he doesn't want to come in and run the business. He wants to basically take over your business, keep you in place, and keep you running the business. And then you just report back to the main Berkshire Hathaway organization, and you just keep running your business the way you want to, or they're going to help you expand it even farther by giving you capital and everything else. So that's a strategic buyer coming in. A third-party buyer is typically somebody who really is out there looking to buy a very specific business. It might be somebody that's wanting to buy a franchise. It's maybe somebody who has been an employee, or they were a business owner before and they decided, well, I've sold my other business, I want to buy a new one and get into that business. So third-party buyers typically are willing to pay a little bit more than a strategic buyer, or more than what a family or key employee is typically going to have. And you want to be able to start thinking about, well, who's that person that potentially could be buying this out? And this is where you would work with a business broker to find out, well, who's that end person. And this is part of our exit strategy process that we're working with when we work with you is, all right, who is that? Who do you think would be the one that's buying it? And how do we position the business to get you prepared to sell? So let's go back to my early life, back to my, age 21, jumping out of an airplane, hating every minute of it. But one of the things that was key to us being able to survive and make sure that we got out of there, the parachute open, and we didn't land on something sharp, was we had a team. And it wasn't just one person. It wasn't just us jumping out of a plane. There was a whole team of people that got us to where we needed to be. It was everything from parachute riggers to pathfinders. They're the people that find the places to land on the ground and make sure you don't land on something sharp. There's truck drivers that took us out to the airfield, cooks, food service people, planning and operations staff, even finance and pay people, because nobody's going to jump out of an airplane for free. If you do, you're crazy. On the Air Force side of things, on the getting you to the ground or to that spot, you had ground crews, jump masters, pilots, crew chiefs, mechanics, meteorologists, air traffic controllers that were all responsible for just getting one person someplace. And realize that in a lot of cases, it might be thousands of people that are jumping out of an airplane at the same time. And all of these people are responsible for making sure all 1,000 of those people get to the ground safely and where they're supposed to be and when they're supposed to be. So that's just for one simple soldier. The funny thing is, people decide to sell their business and they just want to wing it themselves and figure this thing out by themselves. Just as we needed somebody to help us doing an exit plan and exiting and selling your business. And that starts with an exit planner, somebody whose responsibility it is to kind of be the quarterback of the team, help to design the plan, figure out where we need to be, and be able to bring other experts into the fold. An M&A specialist is going to be part of this. So that's mergers and acquisitions. Depending on the size of the business, it may be somebody that's a business broker, or a larger business might be sold through an M&A specialist or mergers and acquisitions firm that does that. Accountants are going to be critical to this, because it's not just doing the accounting basically, on your taxes and everything else. This is also about structuring the deal to make sure that you pay the minimum amount of taxes that you possibly can as a result of this. So this is really working with the rest of the team to determine, okay, how do we structure this deal to where we can keep our costs really low in that process? A lawyer, and it might be a couple different lawyers at this point. A lot of times we work with a tax attorney who is really, an expert when it comes to M&A and understanding, well, there's different ways to sell a business. And if you structure a deal one way, it might create less of a tax for them. And that's where they, the tax attorney and the accountant may be working side by side. You're also going to need someone who can draft the documents, negotiate the deals and things like that. That may be that same lawyer, or it may be a team of lawyers that are doing that. You're going to need a wealth manager, because you're going to get the biggest check you've ever seen in your life, and you need to know what to do with that. You can't just put it in cash and hope that everything works right. You need to have somebody that understands, okay, this is how we're going to generate income. This is how we're going to get all this part through the process. You're going to need an appraiser. Somebody's going to have to figure out what the business is worth today, and then what the business is worth prior to you putting it out on the market. You might need an IT specialist, because there might be some unique things within the IT side of your company that need to be buttoned down before you try and sell it to somebody else. Probably going to need an insurance advisor. A banker needs to be involved a lot of times. You might even need a coach or a virtual CFO, because you might not be ready yet. And I will tell you, out of 10 deals, our business broker friends will tell you that only about 2 are really ready at any given time, or they're kind of being forced into it. But there's 8 that aren't ready. And of those 8, about 4 to 5 are salvageable. They just need some work. So that may mean that you can't sell right now or in a year or whatever. You've got to put some work in. And that's where bringing in a coach or a virtual CFO who can really sit down, look at your business, help you to kind of reorganize things, be in that second set of eyes looking in from the outside, help you to get to that point, and also provide accountability to make sure you get to that point, so that we can get you to the sale point. The next step in the process is going to be due diligence. Now, due diligence is where people are going to be looking at every aspect of your business. They're going to be looking at the financials. They're going to want to know everything. They're going to give you a laundry list of things that they want to know about your business and understand how you run it, understand what, even down to the contracts that you have and the leases that you have. They're going to want to know all of that. Now, if we've done a good job in the exit strategy planning process, we've already thought through most of these things, and we've tried to eliminate this before we even took it to the market. But they're still going to dig in, and if they see anything that's just a little hinky, they might start to dig in deeper and deeper and deeper. Now, this is a point where you start to look at your business, and this is something you've spent years building. You love your business. It's your baby. And your baby was the perfect and most beautiful baby that's ever out there. You've built it. You've got wonderful employees. Your clients are wonderful. Everything is fantastic about it. And then somebody's telling you that your baby's not as pretty as you thought it was. They're kind of telling you have an ugly baby. And this is where you've got to have patience. You cannot blow up. You cannot, start to get snippy about it. You can't, say, well, no, I'm not going to provide you this information, because if you don't, or if you do, you can easily end up blowing the deal, because people start to say, well, why are you being so defensive about this? So you have to have patience. You have to understand that they're just trying to do their due diligence for either themselves or their investors that they have inside their business, so that they make sure that they don't make a mistake. Because once you write the check, or once they write the check to you, there's really no going back. They might be able to sue you if there was some kind of fraud, but if they didn't do their due diligence, they're kind of stuck with the business at that point, and you're off on the golf course or out fishing or whatever you want to do, and you've got the money. So be patient, understand that it's, there's going to be people coming in talking about changing how your business is going to be in the future, changing how you would, it may not be the way you would run the business, but understand that's somebody else coming in to take over the business. And you need to be patient and keep your cool in these cases. So let's talk a little bit about Catherine. This is a case study. And as I told you, this is based on a client of ours and a situation we came up with. The whole story behind it is, she's been in business about 20 years. The first years of her business, she really created a business that didn't exist before. And it was hard at the beginning for people to understand what she did and how good she was at it. But after 20 years, she's running a fantastic business that basically has no competition that's out there. She's 60 years old now. She's looking to exit in about 10 years. And this all came out of originally a CPA referring her over to us to get a business valuation so that she could kind of get a handle on, well, how much is the business worth today? And needed this for her bankers and everything else. Well, we ended up valuing the business about $7 million, which was somewhat of a shocker for her because she just didn't think that it was worth as much as it was. And I just happened to get to the office or get to her office one day before my business partner did. And we just started having a conversation, getting to know each other. And, I'm naturally curious. So I started asking, well, when do you think, how long do you want to run this? And that's where she told me, well, I want to run it for about 10 more years. And I said, well, what's the next step then? Is it going to be that you're going to sell it to a competitor or somebody outside, or is there a key employee that you're trying to bring into the business to be able to take it over? And she said, well, I brought in a key employee who used to be a client of ours and brought her in. Her name is Vivian, and Vivian really is kind of my heir apparent. I mean, she's my right hand. I'm training her how to do this business. And, in future, I would like her to take it over. And I said, well, do you think she's going to have enough money to be able to do that? And she laughed and said, no, there's no way based on that $7 million. She wouldn't have that. And, as I discussed this with her, I said, we really want to, if you want to talk about exit planning, we really need to look at ways for you to not have to be stuck financing the entire thing or any at all. So looking for that. And so Catherine was open for ideas. So we actually created a proprietary solution specifically for them that we've used with other companies. So our solution was, we've got ABC company and it is doing fantastic. It cash flows well, brings in a lot of money per year, and it has a lot of free cash flow at the end of the year that her CPA has been telling her, well, you've got to do something with that. You just can't leave it sitting in the business. You need it to be doing something else. And she's in a business that's a service. So there's not anything she can really invest in from an inventory standpoint or anything like that at the rate of cash flow that's coming in. So we started to sit down and say, well, what does this really look like? And we came up with a concept called a key SOP. We knew we had 10 years to go, which was great. I mean, ideally this works, 10 years is a good time horizon to be thinking about this. And we knew who she wanted to have take over the company, which was Vivian. And we figured, well, about year 7, that's when the transition would really start to go into effect. And Vivian would really start to take the business over while Catherine still remains the owner of it. But she's starting to really be more of a mentor and keeping the business rolling. And we determined that there was enough money that was coming in that we could deflect some of that to ensure that Vivian stayed on board for the full 10 years, and she had enough capital to be able to get a loan to buy the business from Catherine. So we were able to determine that about $50,000 a year, Catherine was comfortable putting aside for Vivian. Now that goes into what's called a key SOP. It's a key employee structured ownership program. And what that means is she basically has a 10-year period of time that if she decides to leave the company, she's leaving that money behind. That money is still owned by ABC company. It is not in her hands. That's something that is deferred and it's sitting out there and it's being put aside for her to get to that year 10. Now, if she gets to year 10 and they decide, well, we're not going to sell the business, then we're selling the business to somebody outside, or she decides she doesn't want to take it over. Well, that's her bonus for doing that. The whole key to this though is we want her to take over and transition and have the capital. So this is an encouragement to say, well, you've got to stay to get this money in the end. And we did put a few caveats that you're not going to get the full amount if you decide not to buy the company out. Well, what that does is that gives about $600,000 of collateral from the KESOP that could be used as a down payment for a bank loan at that point in time, and an agreed upon price that Catherine would have with her. And that would allow the bank to say, okay, well, we feel comfortable that there's collateral there and you're going to be able to pay the loan payments off. We see what the financials of the business look like. Now, in that same process, we also did what's called a Section 162 distribution from the business. Now, what is Section 162? Well, there's actually a publication 162 by the IRS, you can look it up, that lists everything that is a possible deduction from a business. And that's all Section 162 is. So this is using a distribution from the business, and this was something that she could distribute in the form of a non-taxable dividend or return of capital from the business. So she didn't have to pay a lot of taxes on these distributions coming out, and that is put into a vehicle. Now, in this case, we are using a life insurance policy, and there was a lot of reasons why we did that. One of which is it helped to preserve that money in the case of, and she was a women-owned business, so she got some extra benefits, but you can't have a ton of capital. So this was a way to put that capital in a vehicle that doesn't really show up in that pile. But it also solved a couple of other problems. It solved the problem that if something happened to her, then that money would be available partly for her family so that they could, they would have money out of the business. Because if we haven't gotten to the transition yet, that could be a problem, because if the business, or if Vivian's not prepared to take this thing over from Catherine, that could really have a drastic effect on the business. So that gave some capital to her family to make sure that, they got the value out of the business. What it also did is it gave us the ability that in year 7, as the transition starts to take place and we start to look at funding this with a bank loan, Catherine could step in and always loan some extra money to the business that could be used as capital to secure a bank loan. And then that capital would be paid back to Catherine basically when the sale of the business happens. So this was a situation where a key employee is able to take over the business, and Catherine, once the sale is complete, once the loan is funded, she is all whole. She walks away from that, has no financial connection to the company anymore, and she has the ability to go on and live her life. Now, let's say Vivian starts running the business and things start to get a little haywire and she needs help. Well, she can still hire Catherine back as a consultant to come back into the company, but Catherine doesn't have to come back, and Catherine also is not financially tied to that whole situation. So I hope this was helpful for you today. If you want to learn more, we have written a book, my business partner and I. It's part of the Savvy Business Owner series of books. It's called the Business Owner's Toolkit. And it's really talking about some of this type of work when it comes to non-qualified plans, how to lock down and retain key employees, reward them, recruit, and be able to, structure retirements like we did with Catherine for you. That's available on Amazon, so you can find it on there. Just look under my name, and it's Jeff Kikel. So it's JEFF-KIKEL. It's got all 6 of the books that I've written on there. You can certainly buy it from there. Now, I want to thank you for being part of this today. If you have any questions, or if anything came up out of this webinar and you would like to learn more about this process, or if you've just got a question on it, feel free to email me at jeff@bkawealth.com. You can also get a little bit more information on my website at www.jeffkikel.com. And I also do a podcast every week, typically 3 shows a week. And that's the Money Trekker podcast. And you can see that episodes of that at www.moneytrekker.com. I talk a lot about these topics. We do financial updates once a week. I bring experts on like CPAs and lawyers and folks like that. And then I also interview entrepreneurs. So other people who have either sold their businesses or in the middle of it. And I just like to find out how people got started and how they started their businesses. So I want to thank you today. I appreciate your time, and we look forward to seeing you back here next month for our next Savvy Business Owner series. They are always on the last Thursday of every month, or at last Wednesday, excuse me, of every month. So it's always on the fourth Wednesday of the month, usually at noontime. So if you have any questions, or if you're interested in those, please check us out on those, and we'll get you on the list going forward. Thanks, and have a great day.